Is it a bad time to buy a home? Lots of headlines and housing bears this week citing a Fannie Mae survey that said 65% of respondents now say it's a bad time to buy a house. Only 25% say it's a good time. If Americans think it's a bad time to buy a house, does that mean the housing market is ready to crash? You may have clients thinking this way. The question is, what do home buyers need to know today? How can we communicate with them the data about what's happening right now and what to expect? One way to approach this fear is to ask questions. One great question, especially right now, is what's your time horizon? Is it a good time to buy? Well, what's your time horizon? How long will you expect to be in the house? Is this a house you love? Is it a house you can afford? With this survey from Fannie Mae, people were answering about their short-term fears. They know it's ultra competitive. They know there's bidding wars. They know that inventory is record low. And in that sense, yes, it's kind of a bad time to buy. It's super competitive. It's a bad time to buy. Everyone wants to buy. It's like that old Yogi Berra line. Nobody goes to that club anymore. It's too crowded. So it's a bad time to buy because everybody's buying. This week, I interviewed Bill McBride for our new Top of Mind podcast that we're producing with the Altos Research team. Bill is a highly regarded economics writer who very clearly identified and wrote about the housing bubble in 2005. So I recommend you subscribe to the new Altos Research Top of Mind podcast if you haven't listened already. There's some really great episodes, but listen to Bill's episode. We spent an hour looking for risks facing this housing market. We're talking about this question. Is it a good time to buy? Is it a bad time to buy? The podcast is terrific. If you're on this call, you know that we spend a lot of our time at Altos, all of our time, looking at the data. So these interviews on the Top of Mind podcast are how we add context to the data. It's the boots on the ground. It's the leaders and thinkers in the industry. There's a lot of great interviews already on that podcast. And in this world where we're all afraid and the buyers are afraid, then Bill and I wanted to explore what do we actually have to be afraid of. So, when people ask me, is it a good time to buy? My rule of thumb is don't think about timing. If you like the house and you can afford the house, buy the house. If you don't like it or can't afford it, don't buy it. Don't buy it because you think you have to or you have to get in. Bill, in this interview on the podcast, pointed out that in 2005, when people asked him, is it a good time to buy? Bill would say, don't buy a house now. But he also noted that he doesn't say that now in these conditions. The conditions are very different from what they were in 2005. Bill now might reply with a question. The question being, like, how long do you expect to be in the house? So this is what we're going to discuss today. It's a confusing, scary time to be in the real estate market right now. There are risks in the short term. There are big demographic shifts in the longer term. So we're going to look at what we know right now and what we can see for the coming year already and what people can expect. Big ideas for the day. We know that we're in a rapidly rising mortgage rate environment. We also know that we're in an intense buyer competition market. How do those things work together? We can ask, when does inventory finally start climbing. We have some forecasts for you and some ways to think about what might be coming for inventory. And really, the whole conversation today is about how we help clients through their fears right now. And then we'll spend the last little bit of the webinar today on looking at some of the local markets and some of the things that are really evident across the country right now. We have a lot of people on the call today. Use the chat window, your little Zoom chat window. On the call are also Lael and Jeff from the Altos team, and they will be able to answer questions on the fly for you. Look in that chat for links to things that I might mention. So there's probably a link for the Top of Mind podcast, for example. So they'll be in there that you can go click when I reference things along the way. We'll try to answer the questions as they come along, and we got a lot to hit. So let's get started. Biggest news of the month is rising mortgage interest rates. The 30-year rate this week jumped over 3.9. I think it's settled back down a little bit this week. In this chart, each color here is a year of the last decade. And you can see how in the last few years at the right end of the chart, rates have been falling. They were up a little bit, but mostly flat for 2021. And then all of a sudden, 2022, we've got a big spike at the very far right end of the chart. The interesting thing about this, at 3.9, like 3.93, which we hit, I think maybe Tuesday of this week, it's actually above the long-term average for the last decade. So what we might see is that is a threshold for buyers to start feeling that maybe things are expensive, unaffordable. You can see in here, the last time we were above the long-term average was this spike in 2018. And if you've heard me talk, this spike in 2018 is really a good reference point for how the rest of this year might play out if rates continue to rise. What we can see is rates rose sharply in 2018. They peaked at 4.9% in the first week of December of 2018. And that had the effect of pulling some demand early into 2018 as people were worried about rising rates. And it had the effect of cooling some demand and adding to supply at the end of 2018. And as we started 2019, we actually started 2019 with more inventory than the previous year. And so how much? That's the question. And it's really what we can see already. So rates have spiked up. It is notable that at 3.9%, that's higher than the long-term average, and it may be the threshold that people see. Now, what we don't know is, do they stay here? Do they fall back down? I am not, I have no capacity to predict interest rates. We can only look at what we know is happening to demand, how we can measure immediately in the real time with buyers and sellers, with pricing changes. And that's what we're going to report on here. I don't know whether rates go up or down from here, but I do know that 2018 is an excellent reference point for what might happen to the market. Now, if you've heard me talk, you know that we don't forecast any catastrophic change, no bubble bursting, based on all of the trends that we can see right now. Active inventory of unsold single-family homes in the US this week was down to 256,000 homes. It's record low. It's still falling every week. And it is a long way from being back to normal place. You can see in this chart, I pointed out a few things in this chart. Normally, you can see each year, normally inventory starts ticking up in February, and by March, it's on its way up on the curve. Last year, inventory kept falling until April 30th. And you can see that low point before we finally started getting our climb of inventory, which peaks in June, July, and then starts falling in the second half of the year again. So here's in the middle of this chart here, you can see 2018. 2018 had the rising rates. And so the point there is first week of February 2019. So we had 816,000 homes available versus 768 the year before. You can see a little bit of change, like a 10% increase, not a skyrocket, not a 100% change, not a crashing market, but you can see the inventory climb. And that's what we might expect for this year. What we don't know is when we go over 3.9%, is that enough for people to make it feel expensive? In 2018, it was 4.5%, 4.9 before the market notably cooled. So we don't know what the threshold is. We've been so low for so long. We don't know what feels expensive. But you can see this year is likely to get a little bit more inventory as a result of rising rates. The interesting thing though right now is that all the buyers are locked in from their their rate lock was from December or January. And so the buyers this month don't yet feel the higher rates. They feel a little bit higher, but not really, still ultra low. And so what that means is what happens right now is we get buyers who want to act even more incented to act quickly so that they don't get more expensive mortgage if their rate lock expires. So currently, there are a couple of things to note when you're describing the Altos inventory numbers to your clients. This chart that we're showing here is single family homes. And when you compare, for example, the Altos numbers to, you might see a headline from NAR. The Altos number tends to be a lot lower. And there are a few reasons for this. We actually wrote a blog post, which you're welcome to read and share with your clients or when you want to, when the conversation comes up. But this is single family. Most of the headline numbers that you'll see, like NAR published, will be all property types. NAR includes pending sales in their inventory number. They say that, if a house is pending now, it must have been available inventory in January. So that when they're reporting the January number, they will include that in inventory. But what Altos does is we're looking at, like, if you walk into the market today, these are the homes for sale. So there'll be another 80,000 or so that get listed this week, but there also, a lot of those are going very quickly. Anyway, there's a blog post on that that we can share a link to so that you can go read and share about why the Altos number is as precise as it is, what we're trying to communicate with this. One of the other interesting things that's happening right now with active inventory is normally there's a bunch of new construction that's hitting the market that you can buy, and it's brand new and it's marketed essentially like resale. It's small builders, but what's interesting right now is that because of the supply chain challenges, many homes that would normally get completed in 4 months are now taking 14 or 16 months. And in the Altos number, we're looking at that, you could buy that place now, but you can't live in it. So we're actually taking that out of the available inventory of homes to buy out of this number. You can't, if it's not available to actually live in until next year, we remove it from the active inventory of homes for sale from this count. So what's happening is as in-process inventory gets delayed, that actually decreases from our active inventory. Now, it also means that when that finally gets completed in 14, 16, 18 months, that will add to inventory back then because there's a lot in progress. And so those will eventually help us get a little more inventory, but probably not this year. That's probably adding in the next year. One of the places where inventory traditionally might come from would be distressed inventory, people who due to economic conditions, can't make their mortgage payments and they go into foreclosure, delinquency, and foreclosure. That's not coming this year. And in fact, we just crossed over the record few homes that anywhere in the delinquency pipeline. So we've worked out all of the pandemic delinquencies, the forbearance things, all gone. We're back to record few homes anywhere in delinquency. That means there are record few foreclosures coming. And it's not just a foreclosure moratorium. It is a record few people who are late on their mortgage. And that's unlikely to change because everybody in the country has a 30-year mortgage locked in at 3%, and we're in a booming economy. Employment is up and wages are growing, and in an inflationary environment, that those mortgage payments are even cheaper every day. So what this means is that there's no inventory coming from the distressed market. There are no short sales because nobody in the country is short. There's no foreclosures forthcoming, and I say no, I mean essentially none. What we also know is that the mortgage delinquency rate is likely to continue to keep falling as for example, inflation keeps happening. So the price of the home goes up, the equity goes up, the relative amounts of my payment is lower. So it actually becomes more affordable to make my old mortgage payment. There are very few people with variable rate mortgages anywhere in the country. Only a few people who have it's like 4% of the market that is variable that would have any exposure to rising rates in that sense. So it's very low. So there's very little inventory coming from the delinquency space, record few delinquency, and falling every day. So that look to next month. And that was actually November data that just out from CoreLogic. And we know that the December, January markets heated up and prices are climbing. So that's definitely still falling for several months. So here's what a model looks like if we're to forecast rising rates and these other factors of facing the market right now. Each line on this chart is a year. Each year, the bottom is January, typically would be the bottom is January. And then by February, March, inventory starts climbing. It peaks in the midsummer and then starts falling for the second half of the year. So you get this nice curve each year. 2020, pandemic year, everybody was buying everything. Rates fell, under 3%, and inventory never rose that year. 2021 is the light red line here. And you can see that it got back to a more normal annual curve, but it didn't bottom till April. So then the dotted line here is what may happen, what we're looking to happen for this year. If you expect, what we can see is as rates rise, we know that inventory should start climbing a little bit. The dark blue line up here, the thick dark blue line, that's the 2018 line. And you can see how it started lower and ended higher just a little bit than previous years. Like that's the dynamic that we're looking at. There's no spike, there's no rush, there's no any of those things, but it becomes less affordable for me to own, for example, 2 mortgages at the same time. And so now I sell one of the houses to buy the next one. When rates are at 2%, it becomes really easy for me to own 2 mortgages. And so now I have 2 and it's perfectly fine. But because they're all locked in, rising rates don't impact anybody who already owns. They impact the next purchase. In a rising rate environment, interestingly, the opportunity may be for new home buyers. New home buyers aren't quite as sensitive to what rates used to be. They only know, here's what they are right now. It's time for me to buy. I'm married. I'm having a kid. It's time for me to buy a house. Here's what the rates are. Here's what I can buy. Those life events don't change based on rising rates. So, but maybe my price window changes. So you can see the dotted line, second half of the year, assuming rates climb and assuming we have that same slight slowdown that we experienced in 2018, you can see how we might end the year with slightly higher than we started this year of active inventory. What's wild is it's still almost record low. So it's a little more, but almost record low. There's really no indications of any bulk amount of inventory hitting the market. So talking to your buyers, the question is it a good time to buy? Well, it's competitive. It's going to be competitive. One question is, what do you expect rates to do from here? If you expect rates to go up, maybe now is the best time to buy. So answering the question of, is it a good time to buy, with the question of where do you expect interest rates to go, might help your clients think about their timing. It might help them frame their answer to that question better than they would without that realization. So that's what we could see for inventory for the year. This is a model, it's a forecast. We change it every week when we get the latest data points. It'll be fascinating to see things like, do the new construction things continue to get more delayed, or do some of those get completed this year and we can put those into inventory numbers, and that might add to total inventory by the end of the year. Let's look at pricing. We know right now the median price of single family home in the US is $375,000. That's the dark red line here. It's on its way up for the year. That curves up each week typically through June, and then peaks and then heads back down. We had a plateau last year and last summer at $399, didn't get over 400, but I expect that to cross that threshold in the next couple of months here and reach new highs. The interesting one here is the light red line on this chart. This is the price of the newly listed cohort. So each week, a new set of homes come to market, and each week those sellers and those listing agents know all of the information about their local market. They know how many bidders were on the last house. They know how many people are in the open house down the street. They know that nobody's needing to take price cuts. They know that things are moving quickly. And all of that information lets you price the next listing a little bit more aggressively, like a little bit higher. Let's capture a little bit more of that. Each time somebody tries to, let's put it up here and see if we get the bidders. Each of those things is a signal. And what it means is that right after the first of the year, the new listings pricing starts spiking. And each year you can see, each year it spikes there. What's interesting is you can tell the price curve for the year based on how fast those new listings are spiking. And this year they are spiking very quickly. So normally by the middle of February, you can see there's still a gap between the light red and the dark red line. But the light red line is closing that gap. Last year it closed the gap in March, but this year we've already closed the gap. That means that the new listings are getting priced as aggressively as everything on the market. And it's likely to turn up. So the light red line leads the dark red line. And so it's showing that we are going to continue to have our price spikes for at least the next, through the peak of the summer. By then, we could imagine that maybe there is some, the inventory buildup, affordability, payment affordability, if rates climb, could definitely put a cap on how far it spiked, the prices spike for the year. So as of right now, the data looks like easily another 10% home price appreciation year, 10 to 12%. But you could imagine that gets muted a little bit if rates continue to rise, and because we don't know how high they go, and we don't know how sensitive to that consumers are. But the signals right now are all very bullish on buyers, on pricing, and really therefore keeping the inventory low because people are buying everything in sight. Let's look at some of the leading indicators of pricing. This is the percentage of homes on the market taking a price reduction. You can see our nice annual curve. We're just about the lowest point of the year. New inventory comes on in the first quarter. If you list your house in January to get ready for the spring, and then all of a sudden it's still on the market in March, maybe you've overpriced it and you take a price cut. So price cuts start ticking up in March of each year normally. Last year they didn't because people were overbidding and there were bidding wars and there's no inventory. So people were taking everything they could. So price reductions kept falling. Normal price reductions nationwide is about a third of the homes are overpriced before they take a price cut. So there's always price reductions. There are always some who are testing the upper limit. And about a third is normal. In a lot of local markets, in fact, the local markets that I have pulled up on the Altos reports to review at the end here, a lot of local markets might be 40% might be normal or 44%. What we know is that if 35% is normal, we've had this time of year is really about 24, 25%. That last year we were only at 19. So a third of them think they're overpriced, but a lot of those people are getting their offers. And so only 19% have to take a price cut. And this year we are now accelerating, meaning fewer homes taking price cuts than even last year at this time. So this shows us that as of right now, rising rates have not cooled at anything. In fact, if anything, maybe rising rates have accelerated demand for the first quarter because people want to get in before the rates rise. And so fewer price reductions right now. Back to our 2018, 2019 window with that rising rate. So like looking back at what happens when rates rise. What happens when rates rise, you can see the difference between January of 2018 was 24.1% of the market had taken a price cut. So by 2019, that spring of 2019, the rising rates had cooled the market a little bit. And so 27%, 28% took a price cut. So the difference is just a few more price cuts, just a little bit of inventory build. That was the result of rising rates. And that was how the market responded. And that is the model that we're using right now for what we could expect, what we should expect for this year, the rising rates in this year. Again, it's like, when people say, what's going to happen with rising rates? Well, we can see the slowdown that does happen. It's real. And you can feel it. If you were selling and you went to market to sell in August of 2018, you were like, oh, damn, did I miss my window? You could feel it. But ultimately, it was fine. People sold their homes. It wasn't catastrophic. There's nothing in the data that says any kind of catastrophic change, but you could imagine a little bit. So you can imagine sellers, if a seller is thinking about timing, like it's probably peaking right now. And if they're like, is it better to get it out now or to wait till August? Like you can point to the 2018 window and say, look, August it's going to be fine. But if you don't want to worry, now's your peak. So timing wise, you could use price reductions when communicating with potential sellers. We've been using the immediate sales tracker. One of the most powerful phenomenon of the last few years is that the percentage of homes that are getting listed and taking offers essentially immediately. That is sometimes within hours or at least a couple of days, and then not even staying on the market a week. Sometimes these are homes that are pre-marketed and then they just take their offers and get listed and then pending in moments. But what we know is about 30% of the homes are going into contract essentially immediately. So that's the light part of the line here. Each line here is a week. The dark red are new listings that took longer than a week to stay on the market to get their offers. And the light red portion are those that got listed and went into contract essentially immediately. As the market cools, if the market cools, one of the phenomenon that we should expect is a lower percentage of the new listings that go into contract immediately. The first thing that happens is buyers say, wait, maybe I'm going to have a little more selection. Maybe I don't have to place an offer on this right now. In the fall, we went to, it went from like 20 multiple offers to 4 multiple offers. It was still multiple offers and we were still going immediately. We never even got to those that had any opportunity to actually decrease our immediate sales. But for buyers and sellers, what we're communicating here is that the properties that are priced right do have the opportunity to go immediately. It means you don't have to worry about alternative financing things. You don't have to worry about iBuyers. You have the opportunity to sell immediately the well-priced property. And that has not yet declined at all. Percentage-wise, it's in fact getting greater. More homes are going immediately. But it's one area that I look for as a leading indicator to know how much are rising rates actually impacting what we're doing here. We can look at price increases. We'll do a few more, and then we'll flip over to our local markets. So percentage of homes on the market with price increases. These are investor flips. Sometimes they are marketing changes. So if a house might have been listed in December, but didn't get offers over the holidays, you may be now doing a intentional price increase to shift price points to get attention this spring. So currently about 6% of the homes on the market have had price increases. That's really high. You can see each year it climbs in the spring because it's the buying season and the best inventory is coming now. So it does climb, but it's spiking really quickly as sellers, investors, flippers are leaning into the hot demand. What we're hoping is that this doesn't peak at like 8 or 9%. Last year at 9% of the market with price increases feels very scary to me. It's scary because when you have that level of demand, you end up getting, it increases fraud and other bad actors in the space. And those are the signs of bubble bursting that we look for. And what I hope is that rising rates cools the market demand a little bit, takes some of the real froth out of the buyer market. And so hopefully this price reduction or price increases stat tops out lower than last year, gets back down. Normally it might be 2 or 3% of the market, but last year it was 6 and then 8, 9%. Right now we're at 6% again. So again, it's one of those super, super hot indicators that have not shown any sign of slowing yet, but this is where we look. And then finally, let's look at days on market. This time of year is actually, as new inventory starts to come on the market, the actual days on market now starts to decline. Normally this time of year in Q1, you might have 100 days. This includes stuff that was on the market over the holidays. This year we're at 56. Last year, the peak of the frenzy was in May. The whole country, all homes, median days on market was 21 days. We have a lot of those immediate sales going at 0 to 7 days. We have all of the junk, the hard to sell properties, the weird ones, which normally take a long time in a really low inventory environment. Those homes sell. And in fact, it's an interesting listing strategy for agents in your community. Which are the weird ones? Because the weird ones, if they need to get out, now's the time. In a low environment, a low inventory environment, now is the opportunity to sell the weird ones. Like if it's on a high traffic street, it's always going to be high traffic. But right now, if that's your only option, then there are buyers that end up showing up and buying it now. So as a listing strategy, what are the weird properties? Are they ready to sell right now into this hot environment? Because that window may be closing. If rates rise and are persistently higher, we maybe have a significantly less, slower days by this time next year. It's going to be really fascinating to see where the low point is this year. It's starting to fall, and so we'll see. Do we go below 21 days? We'll see what happens there. Um, one thing to make sure when you're looking at your Altos reports and when you're communicating with clients about what's happening in the market, we've been talking about the whole country, all price points, but in our Altos data, we take every market into 4 price range segments, market segments. The high end of the market may be behaving very differently from the low end. And you can see right here, this is nationally, high end of the market's over $1 million. The midpoint is 375. So the upper middle is 500,000. The below middle is, in that 350 range. And then the low end is $130,000. What's interesting is you can see exactly where the demand is. We can see that right now that the middle 2 ranges are about 42 days. They'll drop quickly from here, and you can check. We can look in local markets and see in some of those places already down to 0 days, 7 days on the market median right now, already there. And so we use this price range segments so that you can, your client may say, hey, I want to sell, and I know everything's going fast. And you say, yes, but you're $1 million property here. You're taking significantly longer, maybe twice as long to sell as the rest of the market. We need to price appropriately so that you don't get screwed. We use the price ranges so that we can talk real precisely to them at the local market level. So I'll show you that in some of the local charts in a few minutes. By the way, as I'm talking about these things, I use a lot of questions or scripts, ideas about how to frame the data. So if you need those, you should go grab the Altos eBook. It's how to use market data in your business. It's how to talk to the stats, which ones are important, which questions to ask, the scripts, et cetera, in there. So you can go download that from Altos if you haven't gotten it already. If you're new to Altos, go get that ebook, because it'll really help you understand how to use the data in your conversations. There's a link to the ebook in the chat. I'm sure that Lael has just shared. One last stat, and then we'll switch to local. The Market Action Index is the Altos at a glance measure for answering the question, how's the market? I read that 65% of the country thinks it's a bad time to buy a house. I read only 25% thinks it's a good time to buy. Therefore, they must be not buying, right? The market must be tanking. Well, the at a glance, the Market Action Index in every Altos report lets you look and say, is the market tanking? Is it heating up? How hot is it? It works like a speedometer. And as inventory tightens relative to demand levels, that speedometer is going to go up. You can see that we're currently at 60 on this scale. About 30 is about balanced. Below 30 is buyer's conditions. There's a lot of inventory, and therefore it's correlated with price cooling or stability in the future. But when we're at 60, we're in this strong seller's market, super tight inventory, lots of demand. That's, of course, everybody knows that's going on right now. But then we can watch, is it increasing? Is it decreasing from here? Is it cooling? And right now, the little gray line, it was lower last month. So it's actually increasing nationally for the month. It's March, and that's common, right? Or February, March, April, like that is common as the spring inventory comes on and spring buyers come on. But later in the year, you might say to a client, rates are rising. We know that the market's cooling a little bit. While we have your house listed, I'm going to put this report in your inbox every Monday morning. I want you to look at one number. If you're worried that you're overpriced, if you're worried that buyers are getting scared, we can see that in this Market Action Index, and we'll watch it. If this is falling, if it's falling closer to 30, closer to a balanced market, that means your buyers are weakening, your seller competition is increasing, and maybe we need to get in front of this with our price. So while we have your house listed, I'm going to put this report in your inbox every Monday, and I want you to look at one number. That's what Altos does for you, by the way, is puts that report in their inbox every Monday. This is looking at that Market Action Index over time. The red line in the middle is a smooth one because it bounces around each week, but you can see a few things in here. The big spike last year, and we're just having a big spike right now in the spring, and it's like maybe even going to be higher than we saw last year. Like we have a real demand. And it's really, you can see record low inventory, you can see record high demand, and this is where it shows up. We've been in sellers market conditions nationally for years. It's been a really strong market for a bunch of years. We haven't had real true buyers opportunities for many years. And that's actually another question for buyers is like, well, I'm afraid that all of a sudden there's going to be some inventory and I'm going to buy too soon. I'm going to buy at the peak. The question is, how long are you going to wait for buyer's conditions? How long are you going to wait for that real opportunity? If you can afford the house and you like the house, buy the house. Okay, let's switch now to some local reports, and then we will wrap up the conversation for the day. I have up here a handful of reports. So this is the national one we've been looking at. Here's our market action index right in the middle. We have the price reductions. We can see that we're down to 19% nationally. The price increases are up over 6%. And then when we scroll down here, we were just looking at the price range quartiles, the market segments. We can see these are 4-bedroom, 3-bath homes. Down here, these are 72-year-old, 3 1.5s. These are taking longer, a little junkier to sell. So you can see exactly where the demand is. That's how we're going to read the Altos reports. Let's look at Boise. Boise was a fascinating one. It's one I've been watching because Boise had real powerful inbound immigration from a lot of California, a lot of LA moving to Boise during the pandemic. It's what we call one of the Zoom towns where you can work remote, and Boise was super affordable to a California income. But what happened was I have the price reductions chart pulled up here, and I just click here to get my price reductions chart. Boise is one of these markets where normally it would be normal to see maybe 40% of the homes have price reductions. Then pandemic started, we had a little bit of rise, and then the demand kicked in. So here's 2021. And so normally 40% taking a price reduction, but all of a sudden down here, 4%, 5-6%. And if you remember last spring in Boise, people are buying everything. Then this fall, we were watching the price reductions climb. So it was like some of the inbound immigration slowed. If you'd overpriced your home, you had to take a price cut to let it move. It got back to its normal range. This is last fall when I was sort of encouraged that maybe the frenzy is past us. It turns out, though, that what's happening right now is price reductions are falling very rapidly again. Still way different from last spring, but falling again. The Boise market's picking up for spring and has a lot of price reductions to fall there. But what it shows me here is, what I'm going to be watching is whether these price reductions turn. As rates rise, do price reductions start climbing back to its normal level? That would be a signal that we can really communicate with home buyers and sellers. And you can see in the price segments in Boise, this is city of Boise proper, by the way. You can see that, all of a sudden the top end of Boise, these are LA prices. And you can see that where the greatest demand is, 28 days, is here at the 600, 650 range. And you can see that's where the demand is in Boise. So when your buyers are there, that this is where you're buying in the greatest competition. If you step up a little bit, you still have most of the competition here, but it's a little cooler at the 750 range. And you can see velocity wise, 12, much more transactions happening down here in the lower half of the market than in the upper half. So that's Boise. I was looking at San Diego recently. San Diego is screaming. It's also had a ton of inbound immigration. It was already more expensive, but you can see when we're looking at price reductions in San Diego, we're already below. So San Diego is normally a 40% market. And then we were down at 30%. Last spring was at 19%. We're already only at 14% in San Diego. Like San Diego is looking as hot as it could be, hotter than it was last year. The market action index is up here at 88. Like it's super high. We can look here at chart. Rents are rising. We can see that the days on market is already only 14 days. So, nationwide we're at 56 days, but in San Diego, it's only 14 days. All of these things are coming into play. And you can also see in here in San Diego, everything's going in, just a few weeks, but you can see the price segment right here at 1.3 million. These are the fastest growing, fastest moving properties. When you get down to the lower stuff here, these are older, smaller, and only 14 days, but you can see like it's taken a little bit less time, a little bit more time to move there. Let's move east, and then we will start wrapping up. So this is Cleveland. Cleveland, like every market in the country, is in strong sellers conditions. You can see Cleveland's ticking up from last month. So the inventory tightening and demand increasing. We can see that price reductions, and I've got the price reductions chart up here for Cleveland as well. So more normally in the 30% range, 35% range. And then last year down to 20. And you can see in Cleveland, price reductions are already below last year at this time. And it looks like we're going to hit, this record hot market down here as well. You can see in Cleveland, the low end of Cleveland, these $56,000 homes, these are real junk. And you can see that they take 90 days, where the rest of the market is also. Cleveland's middle of winter still, so their market is a little bit later than, say, San Diego. And then let's look at Orlando. I always like to keep my eye on what's going on in Florida. We can look at the market action index climbing rapidly in Orlando. We can see that price decreases. So I've got the price decrease chart up here. Normally Orlando, there's a lot of investors, a lot of institutional buyers and things like that. So normally price reductions in Orlando is in the 40% range. Then last year it was 30, but it was a little bit later started. So, we got as low as 17%, 18% in Orlando before it cooled for the fall. But look, we're already at 20% with price reductions, meaning there's already record low inventory. There's tons of buyers. It's shaping up to be a hotter market in Orlando. And remember, one of the things I talk about this as a leading indicator, price reductions as a leading indicator. Here's what happens. House on the market now. And if it's on the market now, and if it doesn't get an offer, now it's March and it takes a price reduction in March. It gets an offer in April. It closes in May. And then in the traditional data, you start learning about that in June and July and August. So the headlines will be reporting June, July, and August. What we can already see today in the data, there are very few, almost record few homes in Orlando that are taking price reductions right now. That means that the transactions that close in March and April already have price support. They already have multiple offers. So we can already see the future transactions are already going to be super strong because of one of the leading indicators we can use as price reductions right now. And so Orlando looks like a very strong price appreciation year. And then we can go down to the market segments and we can see exactly this 350 range. And this is 350, 375 that's the national median average, right? They're the median price. And so you can see exactly where the demand is in Orlando, right at the national median. And you can imagine this is people moving from Cleveland and New York and all over to migrate into Florida. And like, that's the home price. It's also the buy box for the institutional buyers. The iBuyers all look at that same price range. It's much harder for them to do deals in the $1 million range. So that's what's going on in Orlando. You can see it already in the data. Okay. That's all we have time for today. Thank you so much. If you are looking for the mechanism to communicate this data with your clients, go to altosresearch.com and book time with our team. Grab the ebook. Like, if you're sitting here going, Mike, we didn't have time to look at my local market. Can we do a local market? We can. Go to altosresearch.com, book time with our team. We'll do your local market. We can brand the reports for you so that your clients know exactly what's happening right now, and they're not waiting for August to know what's going on in February. So that's all the time we have for today. Go check out the Top of Mind podcast. I can't wait to share more with you there. So much going on. Back next week with the weekly data. Thanks, everybody.